Every trader dreams of catching the exact top to sell high and the perfect bottom to buy low. But how do you identify those points before the crowd catches on? In the world of trading, tops and bottoms refer to key reversal points, the moments when a trend is about to change direction. A top is where the price hits a ceiling before falling. A bottom is where the price hits the floor before bouncing back up. Let's break these down using a story. Imagine a mountain hiker climbing to a peak. He's been going up for hours, and eventually he reaches the top, breathless, exhausted, and ready to come down. That's your double top. Now picture a valley walker who's been descending for hours. He finally hits the lowest point, looks up, and decides to head back uphill. That's your double bottom. Both moments, the hiker turning back and the walker beginning to climb, are signals that momentum has shifted. What is a double top? A double top is a bearish reversal pattern. Think of it as the price trying to break through a resistance level twice, failing both times, and then falling, a clear sign that buyers are losing control. How to spot it? It shows up after an uptrend. You'll see two peaks at a similar price level, with a dip or valley in between. The pattern is confirmed only when the price drops below the neckline, the lowest point between the two peaks. The second peak usually forms on lower volume, indicating fading buying pressure. Why it matters? This is often when smart money starts exiting. Retail traders might still be buying, thinking the uptrend will continue, but institutions may already be selling. What is a double bottom? On the flip side, a double bottom is a bullish reversal pattern. Picture a stock that's been falling. It hits a low, bounces, then comes back to that same low again but doesn't fall further. Instead, it rallies. Key traits. Occurs after a downtrend. You'll see two troughs at a similar level, with a peak in between. The pattern is confirmed when the price breaks above the neckline, the highest point between the troughs. Volume on the second trough is often lower, meaning sellers are running out of steam. Why it's powerful? It tells you buyers are quietly stepping in. The panic is over and accumulation has begun. Why traders obsess over these patterns? First, turning points equals to opportunity. Tops and bottoms signal trend reversals, which means potential profits for those who can act early or those patient enough to wait for confirmation. Second, better risk management. If you misread a trend, it's expensive, but spotting a top or bottom early allows you to place tight stop losses and plan high probability trades. Third, confirmation is key. Volume analysis and other indicators like RSI or MACD are often used to confirm these patterns. You never want to act on shape alone. Many charts look like double tops or bottoms, but don't complete the move. Let's say a stock like Reliance has been climbing steadily and hits 2,800 rupees. It pulls back, then rallies again to 2,800 rupees. But this time volume is lower. It stalls. Then it breaks below 2,700 rupees, the neckline. That's a double top, and it's time to reassess your bullish stance. Now imagine the reverse. A mid-cap stock drops to 400 rupees, bounces to 440 rupees, and comes back down to 400 rupees, but holds. Then it surges past 440 rupees. That's a double bottom, and the bulls may be back in control. Final thought. Tops and bottoms aren't just patterns on a chart. They're stories about psychology, about exhaustion, and about shifts in control between buyers and sellers. If you learn to read these stories correctly, you'll stop chasing price and start anticipating it.